What if I told you that one of the biggest problems in investing is actually tied to an old, mind-bending philosophy puzzle? Sounds wild, right? But it's true. Bertrand Russell's barber paradox, something about a barber who shaves only those who don't shave themselves, might have a lot to teach us about making smart choices in the stock market. Here's a shocking fact. Studies show that individual investors often underperform the market by 4% or more every year. Why? Because they get caught in confusing loops of decisions, much like the barber paradox. They think they're making smart choices, but their own reasoning trips them up. Understanding this can help you break free from these cycles and make better investment moves. In this video, I'll show you how this paradox connects to value investing. You'll learn how to avoid falling into common traps, why emotions mess with your judgment, and how to find hidden opportunities in the stock market that most people overlook. Stick with me. You might just walk away with a new way of thinking about investing that could change everything. Chapter 1. The Awakening. Realizing the power of value investing. Value investing isn't just a strategy, it's a mindset shift. Imagine investing in companies that are undervalued by the market but have strong fundamentals. This simple yet powerful concept can change your financial future. The idea is straightforward. Buy low, sell high, but with a twist, focus on quality over hype. Warren Buffett, one of the most successful investors of all time, once said, "Price is what you pay. Value is what you get." This statement hits home because value investing isn't about following trends. It's about looking beyond the noise and focusing on long-term gains. Think about it. Companies often trade at a lower price than they're worth because of market panic, not their true value. That's when value investors step in. They look for bargains, undervalued stocks that will eventually rise as the market corrects itself. One key strategy is to look at the price-to-earnings (P/E) ratio. A low P/E ratio could signal a bargain, but you must dig deeper. Compare it with industry peers to understand if it's truly undervalued. However, don't fall for just any low P/E stock. Look for companies with a strong balance sheet, consistent earnings, and solid leadership. Investing in undervalued companies isn't just about cheap prices, it's about buying businesses that have lasting power. In the early stages, your biggest advantage is time. Value investing is a long-term game. When you pick the right undervalued stocks, you're essentially betting on their future growth. It's crucial to know that the market is inefficient in the short term. For example, studies show that in the short run, stock prices can fluctuate irrationally. But over time, the true value of a company shines through. Remember, value investing isn't about guessing or gambling. It's about making calculated decisions. You're buying a piece of a company, not just a stock ticker. Think of it as being a partial owner of a business. So, ask yourself, would you invest in a company that's poorly run or lacks a future plan? Likely not. So why would you invest in its stock? Chapter 2. The Seed Stage. Planting your first smart investment. Starting your investment journey can be intimidating, but it's like planting a seed for future growth. The first step is to find a company that's undervalued and holds strong potential. Don't just dive in without research. A great place to start is the fundamental analysis of the company. Look at its financial health, debt levels, revenue growth, and profit margins. A common mistake new investors make is jumping into the most popular stocks. Sure, tech stocks like Apple or Amazon are exciting, but are they undervalued? Often, they aren't. Instead, focus on companies that are overlooked or temporarily out of favor. These companies often have the potential for higher returns as the market corrects its judgment. One strategy is to check the company's price-to-book (P/B) ratio. If the P/B ratio is below 1, it could signal the stock is undervalued. However, this isn't a green light by itself. Dig into why the market is undervaluing the stock. If there's a temporary issue, this could be an opportunity to invest. But if there are underlying problems, it's best to avoid it. When you make your first investment, it's important to start small. Don't risk too much money on a single investment. Think of it like learning to walk before running. Diversifying your portfolio is another smart move. By owning shares in different industries or sectors, you reduce the risk of any one stock tanking your entire portfolio. The goal is to grow your investments steadily over time. Don't be afraid of volatility in the short term. It's normal for stocks to go up and down. But as a value investor, you're not concerned with daily market movements. You're focused on the long-term potential. Remember, the earlier you start, the more time you give your investments to grow. Chapter 3. The Growth Curve. Riding the waves of smart decisions. After making your first investment, you enter the exciting phase of growth. This stage is where your investments begin to show their true potential, but don't expect instant results. The growth curve of value investing is steady but powerful. The key here is patience. As you ride the waves of market fluctuations, you need to remain calm and make smart decisions. The next step is to reinvest your dividends. This is where compounding really starts to work its magic. Imagine earning interest on your interest. Over time, those small dividends can snowball into significant amounts. In fact, according to J.P. Morgan, reinvesting dividends could add up to 2–3% to your total returns each year. At this stage, you should also start tracking your investments more closely. Use tools like stock screeners to monitor the P/E and P/B ratios of companies in your portfolio. If a stock's value becomes overpriced, it may be time to sell and find another undervalued gem. The market is constantly changing, and being aware of these shifts will help you make smarter decisions. Another smart move during this stage is to stay informed. Read annual reports, follow industry news, and keep learning. As you build your knowledge, you'll become better at spotting opportunities. But also be careful of falling into the trap of overanalyzing. While research is important, sometimes the market overreacts to short-term issues, creating opportunities to buy at discounted prices. If you're feeling uncertain, remember that the growth curve is not about taking massive risks, it's about being consistent. Stick to your investment philosophy. By focusing on undervalued stocks, you're steadily building wealth. History shows that companies with solid fundamentals eventually outperform. Take Coca-Cola, for example. In 1988, Coca-Cola's stock was trading at a P/E ratio of just 12, making it undervalued. Those who bought and held the stock saw huge returns over the years. But don't forget to periodically reassess your portfolio. Companies that were undervalued in the past may not be undervalued anymore. If a stock's growth has plateaued, it may be time to move your investments to more promising opportunities. Keep your eye on the prize. True financial freedom comes with a series of smart, calculated moves. If you're finding this content helpful, don't forget to subscribe. I'll be diving deeper into these strategies in upcoming videos, so make sure you stay updated. Chapter 4. The Harvest. Collecting the fruits of financial wisdom. As you continue your journey toward financial freedom, you eventually reach the harvest stage, where you begin to see the fruits of your labor. This is the moment when your long-term strategy starts paying off. Your investments, made years ago, are now showing significant returns. But don't get too excited just yet. This isn't the end of the road, it's just the beginning of even bigger opportunities. At this stage, it's essential to assess your portfolio's performance. Have your investments met your expectations? If a stock has grown substantially and is no longer undervalued, consider rebalancing your portfolio. The goal is to maximize your returns while maintaining a well-diversified portfolio. Remember, you're not just in it for short-term gains. Value investing is about sustained wealth. Rebalancing your portfolio involves selling overvalued stocks and investing the proceeds in new opportunities. A good rule of thumb is to review your portfolio at least once a year. Don't be afraid to trim the fat. If a stock has appreciated beyond its value, it may be time to let go. But don't rush. Patience is still your best ally. Now is also the time to focus on income generation. If your portfolio includes dividend-paying stocks, consider how you'll use those dividends. Will you reinvest them or take them as income? The average dividend yield in the S&P 500 is about 2%. While this may seem small, when reinvested, it can lead to a significant increase in wealth over time. Let's not forget that value investing is all about assessing the true worth of a company. Even after the harvest, it's crucial to check if your investments are still aligned with your strategy. Is the company still undervalued, or has it become overpriced? The market's efficiency doesn't happen overnight. it takes time for the value of a solid company to be reflected in its stock price. The key here is to keep your emotions in check. While it might be tempting to take profits and run, true value investing requires a steady hand. Consider your portfolio's long-term prospects rather than short-term price movements. You're investing in businesses, not stocks. Hold on to those that still align with your strategy. Chapter 5. The Scaling Game. Leveraging profits for bigger gains. Once you've harvested your rewards, it's time to level up. The scaling game is where you take your profits and reinvest them into larger opportunities. This stage is all about leveraging your existing investments to increase your returns. It's like planting a bigger garden with the seeds you've already grown. At this point, you've gained valuable insights into how markets work. You understand the principles of value investing and have witnessed the power of patience and research. Now it's time to scale your portfolio by making bigger, more impactful investments. It's important to remember that scaling doesn't mean taking on unnecessary risk. It means smartly reinvesting profits where they have the greatest potential to grow. One effective strategy for scaling is to use the concept of compounding. When you reinvest your earnings, you not only increase your stake in existing investments, but you also expand your portfolio into new areas. In fact, Albert Einstein once called compound interest the eighth wonder of the world, because of its ability to accelerate wealth growth over time. As you scale, don't forget the importance of diversification. A well-balanced portfolio includes a mix of asset types, stocks, bonds, real estate, and even alternative investments like commodities or private equity. This diversity reduces your exposure to any single investment and can help manage risk as your wealth grows. Research shows that diversified portfolios tend to outperform concentrated ones over the long run. One smart tactic to scale your wealth is to invest in index funds. These funds track the performance of the broader market, offering a low-cost, diversified investment. Studies have shown that over the long term, index funds often outperform actively managed funds. So, as your portfolio grows, consider adding index funds as a way to keep risk in check while maintaining solid returns. Another approach is to tap into emerging markets. While these investments may carry more risk, they also present opportunities for exponential growth. For example, between 2000 and 2010, emerging markets in Asia grew at an average annual rate of 12.5%, compared to just 5.4% in developed markets. It's about identifying the next wave of growth and positioning yourself early. But remember, scaling requires discipline. You don't want to overextend yourself and chase after every flashy opportunity. Stick to your strategy, focus on what works, and continue to assess your investments regularly. Smart scaling is not about gambling. It's about leveraging your knowledge and gains for more significant rewards. Chapter 6. The Freedom Formula. Mastering the art of passive wealth. The final stage in your journey is achieving true financial freedom, and this is where the magic of passive income comes into play. At this point, your investments are working for you, generating income with minimal effort. This is the ultimate goal for most value investors: to create a self-sustaining income stream that doesn't require your daily attention. The first step to financial freedom is understanding the power of passive income. This is income generated from investments such as dividends, interest, and rental properties. Unlike active income, which requires you to trade your time for money, passive income allows you to earn without constant effort. Imagine receiving regular dividend checks or rental income while you sleep. This is the power of financial independence. One great way to generate passive income is through dividend stocks. Some of the most successful investors, including Warren Buffett, have built their wealth by investing in companies that pay consistent and growing dividends. In fact, according to the National Bureau of Economic Research, dividends have accounted for nearly 40% of the total return on the S&P 500 over the past 60 years. But passive income isn't just about stocks. You can also explore real estate as a source of recurring revenue. Rental properties, if chosen wisely, can provide a steady stream of income. The key is to focus on properties in growing markets and areas with low vacancy rates. Real estate can also offer tax advantages, such as deductions for depreciation and interest. Another strategy to build passive wealth is through peer-to-peer lending platforms, where you lend money to individuals or businesses in exchange for interest payments. While these investments carry some risk, They also offer higher returns compared to traditional savings accounts or bonds. To reach financial freedom, it's important to have a diversified approach. While dividends and real estate are great sources of passive income, don't limit yourself. Consider a mix of income-generating assets, such as bonds, annuities, or even business ventures. The more diverse your income streams, the less vulnerable you are to market downturns. Finally, as you reach financial freedom, it's important to maintain your discipline. The temptation to splurge can be strong, but remember, your goal is to create sustainable wealth that lasts. The habits you developed along the way, research, patience, and diversification, should continue to guide you. At this point, you're no longer reliant on a paycheck. Your money is working for you. This is the true meaning of financial freedom: the ability to live life on your terms, without worrying about money. You've mastered the art of value investing, and now, your wealth is a testament to the power of long-term thinking and smart decision-making. If you found these tips helpful, be sure to subscribe for more deep dives into investing strategies. I'll be exploring more ways to secure your financial future, so stay tuned.